Quick disclaimer, anything we discuss on this video, on this channel, it's not a financial advice for you to buy, hold, or sell any shares, ETF, or any investments. Please do consult your financial advisor before you make any investment into the stock market. Let's move on to the video now. Hello everyone. If you own HHIS or you're planning to own it, this is going to be the most important video you will ever watch. Hello, my name is Vikas and welcome to Passive Income Magnet. So before we move on to the screen, I just want to share my current position in HHIS right now. 51,500 shares at the time of this research, but the numbers are going up every day. I have a total capital of $631,000 roughly invested into this ETF, and my average price is $12.27. Current price at the time of this research is $11.29, which puts me in unrealized loss of $50,470. This ETF is paying me $13,905. That number is always increasing, which is yearly $166,000. And in this video, I'm also going to use the scenario of withdrawing $5,000 every single month. How does it affect the fund for 15 years? We're going to discuss 4 different concerns about this ETF. Everything we'll be discussing, it's going to be for 15-year scenario. And the other very, very important part is the 25% leverage on this fund. We're going to discuss a scenario with the 25% leverage and without 25% leverage. How does the fund get affected by that? And certain concerns like NAV erosion, ROC, which is return on capital, and sustainability. At the end of the video, your view about HHIS will definitely change. So stay tuned. Let me open up my research. We're going to go from point to point, and we're going to run 8 different scenarios for NAV erosion, 2 NAV growth for 15 years, and let's see what numbers show us. For 15-year scenario, and we're going to also consider taking $5,000 away as a monthly income. How the fund is going to perform in bear market crash up to 40% down. Most important thing in this video would be the research that I've done on the 20 underlying companies and how they have performed in the last 5 to 10 years. And most of these companies are the largest companies in the world. Also look at the sectors they are dominating and what can we expect in next 5 to 10 years based on their past performance. So to discuss all these concerns, I have done a very deep analysis, research on that, all numbers. So don't miss even a little bit of this video because you might need to take some screenshots and study them even further down. So let me switch my screen to the research. Let's move on. One thing I did not share that with you guys, to pay off this $50,470 unrealized loss, if the NAV does not recover from here, it'll take me 3.6 months. With my dividends, this amount will be paid off. So the next important thing on this screen, as you could see, I have investment of $631,905, which will be paid off if ETF continue to pay 27 cents every single month on the amount of shares that I have. It'll take 3.8 years to completely pay this amount off. Then I could simply run on house money. Like I said, I'm gonna put $5,000 as withdrawal for this research purpose, which I'm actually doing also on and off, but I still do that withdrawals every single month to use against my household expenses. So after this deduction of $5,000, I'm left with $106,860 to reinvest back into this fund. Monthly remainder is $8,905. Like I said, this number is increasing every single day in real life. Okay, let's move on to the second screen. Most of this stuff we already discussed. The only thing I want to share with you, reinvestment part is around 64% and withdrawal is around 36%. So we'll jump to the next screen. So this is the rosy picture. What if the NAV does not move at all? It stays at current price of $11.29. But we'll look into these numbers later on. So let's jump into what most people are curious about, NAV erosion. So we're going to look into that scenario first, and then we'll come back to this scenario, okay? So here's my complete NAV erosion scenario analysis for 15 years outlook. The first scenario is about -8%. So let's look at the bigger picture. This screen, it shows if the NAV erodes by -8% annually every single year. So you could see year 0, 11.29, that's today, and share dividend is 27 cents, and shares I own is 51,500, monthly dividend income which is $13,905, annual 166,860, reinvested $106,860. Remember that we withdraw $5,000 every single month, right? So, and my portfolio value right now with that 50,000 loss is $581,435. Okay, so as we move on, you could see year 1 with the -8% NAV erosion, my value of my share drops to $10.39. So we're also considering if the dividend is also lower based on that, and share price has, and the amount of shares has increased. Sorry, not share price. The amount of shares has increased. Monthly income has gone to $15,144, annually $181,000, and reinvested amount has also grown based on these numbers, $121,000. And look at my portfolio size. That's after the NAV erosion on year 1, $633,000, right? So let's jump into the year 5. You guys could take a snapshot and look at all the numbers here. So year 5, my NAV erode to $7.44 if every single year we're losing 8% of the NAV. Okay, so we're also considering that the dividend will also drop to 17 cents, but my shares have increased because I'm reinvesting a good amount of money back into this ETF. So the shares are gone up to, in 5 years, 128,000 shares, which is paying me monthly, even with the reduced dividend, $22,000. Yearly, annually, it pays me $274,000. And look at my portfolio value. This is the most important part because this is total ROC. I did not made this number up. You could do your calculation by yourself. And year 10, you could see, yes, the NAV has eroded. If it continued to erode by 8%, which is not practical, we're still going to consider that way. So let's say year 10, NAV has eroded to $4.90, and also the dividend has gone down to 11 cents. But my share quantity has gone up to 371,000 shares, which is paying me monthly $41,000 every single month as dividend income. And annually, little more than $500,000. And look at my portfolio value is $1,800,000. And we will jump to year 15. NAV has drastically eroded my capital or my share value to $3.23. So is the dividend affected by that. So we're only receiving 7 cents. In that case, my share has gone up to, look at this number, 1.2 million shares, almost 1.2 million shares. And look at my monthly income. Share that in the comments. What would you do with the income of $91,000 a month? And look at the annual income. It's $1.1 million. And this is the main part here. If you look at the capital portfolio value at the year 15 is 3.846. We're talking about close to 4 million. And that is with the scenario of -8%. And we are reinvesting pretty much everything back into the fund, but we are withdrawing our household expenses. It could be $5,000, but for this research, I've only used $5,000. It could even be more, 8 to 10 grand. So you could see it might make a little difference in the overall numbers. But let's move on to the next study, which is about 5%. If the NAV erode by 5%, look at the numbers by yourself here. In the year 5, you could see my share value has dropped to $8.74, and my dividend has gone down to 20 cents, 21 cents roughly, and I do own 131 shares, and my annual income has gone up to $27,000, and sorry, my monthly income has gone up to $27,000, and my annual income is $328,000, and my portfolio in this scenario would be $1.1 million. And the year 10, you guys could have a look into every single year. Now I'm going to jump to the year 10. Year 10, my share value is 6.76, and we're also considering the dividend has also dropped to 16 cents, but my shares has grown to almost 400,000 shares, which is going to pay me $64,000 every single month. And annually I'll be at 750,000, and then my portfolio has grown up to in 10 years alone $2,684,000 annually. Portfolio has grown in the year 10. So if you're looking at using the same scenario of 5%, we're looking at the year 15, my NAV has eroded my share value to $5.23, and so is my dividend has gone down to 12 cents. Look at the amount of shares I have now, 1.3 million shares, and I have monthly income of $164,000. Annual income is close to 2 million, and look at my portfolio value. Guys, this is almost close to $7 million. I did not make these numbers up. This is with the real numbers here. This is the same example with the 3% and so on. You guys could take a screenshot of that and look at it, but I could tell you in 50, I'm just going to tell you about 5 years, 10 years, and 15 years. My 5 years with the 3% NAV erosion, you could look at it. My portfolio will be sitting at $1,286,000. In the year 10, my portfolio will be sitting at $3,425,000. In year 15, with the minus 3% NAV erosion, my share value will drop to $7.15, and I'll have a monthly income of $236,000. And look at my portfolio value with 3% NAV erosion every single year. In 15 years, I will have almost $10 million. So this is the same example with 1%. You guys could have a look at that one. I probably won't go through that. So now, like I said, I will show you the realistic number if the NAV does not change at all. If it stays the same. Today's value is $11.29 per share, and what if we stay with 27 cents per share dividend for the next 15 years? In that case, you guys could see my monthly income in 5 years will be $35,000, and my portfolio value would be 1.5 just in 5 years. And in 10 years, my portfolio value will grow to almost $5 million. And in 15 years, I will own 1.4 million shares, and which will pay me almost $400,000 monthly income in dividends alone. And look at the portfolio value. It looks very unrealistic. Almost $16.5 million. So let's not just look at the rosy picture only. I'm saying, let's be realistic. Markets will not always stay the same. They will always fluctuate. And in bear market, these ETFs may not perform as good because volatility will not be there, or will be very less, right? But that's why I'm running different scenarios. You can come up with an average just for your own. You can come up with an average. So the next one is if it grows instead of decreasing. If the NAV grows, let's say whatever everybody is saying, it's not happening, but actually the NAV is growing. So in 5 years, the same share value, which is quite possible, it could go up to 13%. It could go up to $13.09. And also the dividend per share has grown, and the amount of shares have grown to 136,000, and my portfolio value with the 3% increase every single year will be 1.7 million, or almost 1.8. In 10 years, my share value could go up to 15.17 cents, and the dividend could possibly increase accordingly to 36 cents. In that case, I'll be making $161,000, and my portfolio will grow to $6.7 million. And look at this number. If 15 years in a row it continued to increase, and we will get into it why why there's a possible chance. I know a lot of you probably thinking, well, that's not even close. We're never going to get to that number. I understand that we're just running these numbers, but when we get to the companies, we'll see how these companies, the underlying assets. The next part of this video is the most important part, where this will probably make some sense. These numbers, they look very unrealistic at this moment, but this is just the next screen, so stay tuned. We're going to look into those numbers and how is it possible to reach out to these numbers in 10 to 15 years of time frame. And so I'm not going to take more of your time, so you guys could have a look at the year from year 0 to 15 years if the NAV grows by 5%, and same thing with the 8%. Look at this number with the 8% NAV growth, and the share price could go to $35 per share, and you know, my monthly income is $1,390,000, and the portfolio value could go to $58 million. So I know it kind of sounds really unrealistic, so wait till we see the next screen where we see the companies, the underlying assets, how are they performing, how they have been performing. So this will make more sense to you guys. So this is just the whole chart. If you guys gonna see it, or you know, do your own math. One thing I want to share with you guys before we jump to the next screen about the companies, the underlying assets. You know, dividends are the engines, and even at -8 annual erosion, you collect 7.49 million total dividend in 15 years, and that's like 11.9x your original money which I've invested, which is $631,905 invested in it right now at the moment. In the best scenario, with 8%, you guys could collect up to $60 million. So it is very, very important to see the overall long-term view. So let's move on to the companies. How are they performing? So these are all the underlying companies. Look at NVIDIA, Broadcom, Apple, Amazon, Alpha, Eli Lilly, Tesla, you know, AMD, Costco, Meta, Palantir, Microsoft, Netflix, Coinbase, Circle, CrowdStrike, Strategy, Reddit, Robinhood, and SoFi. So 13 out of these 20 companies, they are very well established companies. They have shown their performance. Some of the newer companies, they have also shown their very good performance. Well, only if we focus at the older companies, look at their 5-year return. NVIDIA alone has given back in 5 years 1,216%, and in 10 years NVIDIA has given back 25,000%. Broadcom has given in 10 years 3,200%. Apple has given back 630,000. Amazon 780%. Alphabet 490%. Right? Even if you can look all these numbers, some of these were not IPO'd in last 5 to 10 years. That's why it says not applicable, these numbers. But you can still see the 5 years, or you know, some of them they've already shown the growth by 30%. So this is CAGR, which means accumulated. You could see annually these companies have been growing at this percentage: 67%, 50%, 17%, 8%, 25%, 46%, 42%, 24%, 23%, 18%, 43%, 20%, and then 14%, 30%, and so on. And what I look at it, overall picture, because not just one company is playing a role here. Overall, if you could see the best year and the worst year, how did they perform? 2023 and so on. You could have a look at all these numbers, and my magic number here is this one here, weighted portfolio CAGR, the cumulative 33.3%. This far exceeds any NAV erosion scenarios. These are some of the most dominant growth companies in the world right now. So look at the bull scenario, base scenario, and bear scenario. Can underlying companies grow offset NAV erosion? The answer is surrounding yes. Don't just look at me. See the numbers. Base case scenario, HHIS distribution yield is 28.7%. With the NAV erosion risk of 2% every single year, the company growth so far has been 33.3%, which still pays us 31 point, even with this NAV erosion, continues to pay us 31.3 net positive. In the base scenario, with the same percentage as of today, even if the NAV erode by 5% every single year, you're looking at these companies paying 33.3%, and we're still left with 28.3 net positive. The bear scenario, so look at the bear scenario. In case of NAV erode by -8% every single year, and the companies continue to pay us 33.3, we're still left with 25.3% net positive. How the covered call works, we all know, but I'm still going to read this through. HHIS use a covered call strategy capturing approximately 60 to 70% of underlying growth. Even at 60% capture rate, 33.3 times 60%. So we know some of you are going to question, because they are writing covered call on 33% of the portfolio. They're writing covered calls. They could go up to 50%. For this scenario, we're going to use 40%, as if they're writing covered call on 40%, right? So in that case, this 33.3% value that we see, the growth these companies have shown, or altogether as a whole, as an ETF. So we do that only with 60%. The portion of the ETF that's not being used for covered call writing. And we are looking at around 20% captured growth at -8% net erosion, equal to plus 12% positive. The underlying growth provides a natural shield against NAV erosion. Minimum pace growth in bear market sessions. So that's another scenario. Even if these companies grow at minimum historical pace, approximately 12 to 15 CAGR during the bear market, this still exceeds the worst -8% erosion scenario that we looked at. So you could look at it, if Nvidia only performs 15%, normal CAGR was 67.5%, and Nvidia is around 7.2% in this ETF. And we're looking at, you could look at all these numbers. These are the bear market scenario based on if these companies do not perform as good as they've been performing in the last 5 to 10 years. These are the most dominating companies. Most of these companies are most dominating companies in the world. So defense layer, even minimum bear market growth in -7% CAGR, combined with the covered call capturing 60 to 70%, HHIS still generates 4 to 5% growth, which partially offset the erosion in normal markets. The defense is overwhelmingly strong. So this part is, again, very, very important. The second best part of this study is the 25% leverage, because a lot of people are saying this 25% leverage could eat up the fund really, really fast. Yes, in the bear market, the value could drop because it's a leverage. That's how the leverage works. But if you look at these companies, most of these companies have been growing at a very good rate from last 5 to 10 years or even more. And if you look at the long-term picture of stock market, the chart always goes up. Based on that, if we add 25% of rocket fuel on that, that could affect very positively. So we're going to look into some numbers here. Effective exposure, without leverage right now we're sitting at, so these are the two scenarios we're going to see if we have 25% leverage or without leverage, how these numbers could change in 15 years. So first of all, current value right now of my portfolio is $581,000, as we discussed in the beginning. Monthly dividend is $13,905. Annual is $166,000. And net reinvestments that we're doing is $106 $15,000, and in 15 year at only 3% NAV growth, my portfolio could grow to $27 million. And look at with the leverage what's going to happen. With the leverage on top of this amount could change to $726,000. That's just my capital alone. And look at the 15-year scenario. In that case, we're looking at $33 million. So look at this scenario in 15 years with only 3% NAV growth. We're looking at a boost from here to here of $6.7 million. So risk note, leverage amplifies both gains and the losses. In a minus 8% erosion scenario, leverage added additional drag. However, the enhanced income from leverage also means more reinvestments going back into the fund, really offsetting the downside. So all these funds are going back to the fund. Even if it's eroding, values dropping, the reinvestment that we're doing, it's not only increasing monthly dividends, but also increasing the amount of shares, which leads to more share quantity and balancing the price of share as well, which we call it NAV at this study. The net effect of the leverage is a high yield reinvestment strategy is generally positive over long-term horizon. Like I said, all these companies, because they're on an uptrend, the stock market is on an uptrend. If you are in a market in general is on an uptrend, if you are invested in stock market, equity investments are the most riskiest investment as compared to the other investments. So if you look at that scenario, the markets are always going up. Whether you are invested in the growth ETFs or growth funds, I am not against any of that. By all means, like you have seen my previous video, I've started a new portfolio. I used to own all these growth ETFs and assets. I still own some of them, and this is how I grew my portfolio in the beginning to reach it to the point where I could actually invest into HHIS or ETFs like HHIS and generate my monthly income. So we're going to look into this. This is also very important because some people are going to come up with this scenario. What if the market crash, right? Happen after a minus 40% market crash. So modeling the worst case scenario in immediate 40% crash followed by varying recovery speed. In this scenario, just to simplify things, we're going to see the speed that it could recover if the market crashes and how it's going to affect in 5, 10, and 15 years after that crash. So portfolio value, as you all know, is $581,000. After the crash, it could drop to $348,000. That is a change of $232,000. Obviously, when the market crashes, everything crashes with it. And NAV, as we talk about the NAV, it could drop to $6.77. It's a change of $4.52. It's a big drop. Obviously, it's going to change the price. Monthly dividend is from 27 cents to 16 cents only. And then we're looking at monthly income drop from $13,905 to $8,343. That's in the scenario if the market drops by 40% now. Now we're going to look at the main concern. How is this going to recover? How is it going to recover in 5, 10, and 15 years? If you see, even with the 2% growth per year, we're talking about the NAV growth. If the market drops, it also recovers. We're only looking at 2% in this case. My portfolio in 5 years after this scenario will go back to 1.2 million. In moderate scenario, if NAV grows by 5% per year in 5 years, my portfolio value will go to 1.6 million. And with the 8% scenario, my portfolio will be 2.1. And respectively, if the V-shaped recovery happens and 12% per year growth will bring my portfolio to 2.9 million only in 5 years after the 40% crash. Look at the 10-year scenario. With 2% growth, 2.8 million, 5%, 4.5 million, 8%, 6.8 million, and with 12% V-shaped recovery, 11.2 million. Let's not talk about the V-shaped recovery because market usually recovers slowly. So we're going to stick to these numbers only. Most likely the middle part is an average, right? So crash resilience. This is the conclusion of this study here. Even after a catastrophic crash of minus 40%, with a slow 2% recovery, your portfolio still reaches 6.5 million by the year 15. So the secret, lower NAV means your dividend buy more shares. The crashes are actually buying opportunity for dividend reinvestors. So this scenario was also very important because market crash could happen anytime, and we don't want to be left behind. So that's why I wanted to include this. It was very, very important. So let's look at the future growth catalyst for HHIS holding. First of all, we have to understand what are these companies doing. Nvidia is an AI chip dominance, data center boom, autonomous vehicle, Broadcom, they're doing custom chips. Again, it's AI network infrastructure. They do custom chips for all these large companies and more. Apple is a service revenue. Amazon, as you guys know, they're putting their hands into every single business. These are advertisement growth along with the healthcare market. They're putting their hands into every single thing. And we all are familiar with Amazon because we do order every day or every week something from Amazon. Alphabet, always been a good cloud player. Right now, Google Cloud AI platform, they're also putting their hand into the autonomous taxis, which are Vimo, excuse me if I say it wrong. Again, Eli Lilly, again, this is the dominating in Madison market. Tesla, full self-driving autonomy, energy storage, and robotic. So Optimum is also going to change the word as we're all expecting. AMD, same thing with the AI GPU competition. And then we're looking at Costco. I've been personally using Costco from last 30 years, and I've never seen Costco stops. Costco is always been growing. Meta, AI generation, across apps, real monetization growth, metaverse, long-term. Metaverse, I think Facebook has pulled themselves back from it. I could be wrong. Palantir, in last couple of years, government AI contract expansion has brought Palantir from $5 a share to all the way up to 200 plus. Microsoft, Copilot AI across Office 360. This is on auto subscription base. Automatically money is being charged. These companies are collecting massive amount of wealth by auto subscriptions. Netflix, same story. Even if we talk about the growth of new holdings, such as, companies like Coinbase, crypto infrastructure backbone, Circle, USDC stablecoin dominance here, CrowdStrike, cybersecurity cybersecurity are definitely going to grow along with the AI as well because AI will need it. MicroStrategy, we all know, MSTE, I think a lot of people are invested in it, including myself. And Reddit, data license for AI training and so on, advertisement and things like that. Robinhood, crypto trading expansion and retirement accounts, gold, international markets entries. I mean, Robinhood is growing. So SoFi, I personally really like their growth and the type of things they're doing. I do compare SoFi with Wealthsimple. It's just my own personal thing. But even if we don't consider these last few companies, and they're not really heavily allocated in HHIS also. Most of these companies are around 2.7 to 2% only. But mainly, these are the companies actually rolling the snowball effect because they are growing over the years. This is what I'm counting on it. I could be wrong. Do your own research. This is just my scenarios. So based on this studies also, we ran the numbers based on how these companies been growing. So let me move to next screen. At the end of the video, I'm going to share 6 takeaways for every investor who is invested in HHIS. They need to know all these things. Income powerhouse. So based on my portfolio, I'm making this income. I mean, it's still paying me while I'm sleeping. Second, it's a compounding snowball effect. Reinvesting creates an unstoppable snowball. Even at zero NAV change, your monthly income grow from $13,905 in my case to almost $400,000 by year 15. That's like a 28.5x growth. monthly income we're talking about, purely from reinvestment compounding. This part is very important because a lot of people are concerned about it. NAV erosion is manageable. So we have also ran the scenario of minus 8% per year for 15 years in a row, with 8% per year decline in NAV with dynamic declining dividends. So we also consider that dividends are also falling along with the NAV. Your portfolio still reaches 3.85 million in 15 years. That is 6.6x my investment could go up to. And I accumulated 1.19 million shares by year 15. So erosion is scary on paper, but irrelevant as per this study in practice. If you look at these numbers that we just shared, dynamic dividend reality. While dividend decline in erosion scenario, the lower NAV means you buy more shares with each dividend. At minus 8% erosion, you go from 51,500 shares to 1,190,071 shares. That is 23x increase in share count that partially offset the dividend decline. Volume compensates for per share drop. Company growth your shield. This is the most important part I'm looking at, because I am counting on the companies. Every time you buy a share of a company, we're basically looking at the companies we're buying. Are they profitable? Are these companies gonna do good? Have they been doing good? So based on these companies, as you could see, the CGAR, the company was 33.3 in 5 to 10 years. So I am counting heavily on these companies for sure. And even at the minimum base market pace, as we saw, in the bear market, the company growth provide a natural defense against NAV. These are the world-class companies with dominant market positions. The last paper loss is irrelevant. My $50,470 unrealized loss, dividend recovered that in 3.6 months only. Over 15 years, even at minus 8% erosion, I collect 7.49 million in total dividends. That is 11.9x my investment. Stop watching the NAV, watch the income. So we also wanted to see how does it affect the capital gains or capital losses. So you guys have seen the study. So the bottom line is HHIS is a high yield income machine where dividends do the heavy lifting. So that's why we're focusing again and again on dividends. NAV erosion is real but manageable because of dynamic reinvestment, buying more share at the lower price, right? 20 underlying companies have strong growth fundamentals, 33.3 CAGR, 25% leverage amplifies income generation. Even the worst case scenario delivers 6.6x your investment over 15 years. The math works. So after looking at all these numbers, let's answer that question. Can HHIS go to zero? Technically, any investment can go to zero. But for HHIS to go to zero, 20 of the largest companies in the world, Nvidia, Apple, Amazon, Microsoft, Meta, Google, all would need to go to zero simultaneously. So is the NAV erosion real? Yes, absolutely. While you're holding this fund, your share price might not return your capital back. Your share price will likely not return your investment. That's the trade-off with the income. Are you losing money? Here's where it gets interesting. We ran different scenarios, right? You're not losing money. As we have seen the study and the chart that I just recently shared with you, you're not losing money. You're converting growth into income. That's the fundamental trade-off of covered call strategy. So whether this trade-off is right for you, it all depends what you need and what you're looking out of this investment. If you need growth and you're 25 years old, this probability isn't for you. If you need income, for my example, it's $13,905 a month, which is increasing every month. If you need income and you want $13,905 hitting your account every single month, in that case, this deserves a serious look. But don't let fear videos make decision for you. Do the study, run the numbers yourself. Look at the real data and make an informed choice. I'm not here to sell you HHIS. and I'm not telling you everything is fine. I'm here to show you what numbers says, and you can make your own decision. If this video helped you think about HHIS differently, not bullishly, not bearishly, but clearly, please hit the like button. It only takes a second. It helps the HHIS investor to find these analyses. Please subscribe to the channel if you haven't yet. It doesn't cost you anything. Please do that right now. It helps grow the channel, and and I'm going to keep tracking this investment publicly, the gains and the losses. Please drop a comment. Are you holding HHIS? Are you buying more? Or are you selling? I genuinely want to know. At the end, I just want to say everyone's risk appetite is different. So do your own due diligence. Take only risk as much as you can digest. I want to thank you for watching this video and this analysis. Be a part of my journey. Thank you so very much for watching, and I'll see you in the next one. Bye for now.